you take a step back, in this current economic environment, we've seen basically 6 quarters of at or above potential U.S. economic growth. And I think that's really important because what it highlights is, despite the fact that there's been an elevated rate environment for the majority of that experience, growth continues to be relatively strong in the United States, and sufficiently strong to keep the economy tight, to keep labor markets tight, and to keep incomes continuing to grow sufficiently to keep nominal spending elevated. And so at its core, what we see here is, if anything, an acceleration a bit in the second half of the year relative to the first half of the year, which is notable in the context of the fact that interest rates have been at these levels for by now an extended period of time. If you run through this scenario, basically what's going on here, you can see on the left-hand chart is the quarterly GDP numbers, which we had a 3.3% print for 4Q23. On the right-hand side, some more timely numbers where you see that demand particularly has remained pretty strong and was very strong in December. We see employment continues to be very strong across the economy. So on the left-hand side is payroll growth, which remained quite strong through the course of 2023, and if anything, showed a touch of acceleration into the back end of the year. The unemployment rate there at 3.7 at secular lows, continues to be at secular lows, and has been basically in this range for 18 months. And on top of it, when we look at more timely indications of employment, whether it's initial or continuing claims, they all point to, at least through January, a continuation of this relatively strong employment circumstance. It's also important to recognize that it's not just demand and employment. Some of the most cyclically sensitive parts of the economy are starting to improve. Inside, we see Michigan consumer sentiment, which is at highs of the last 2 years. And we see on the right-hand side a sense of what's going on with homes, lots of different ways to measure it. But we have seen an improvement in housing activity, purchases, sentiment, a wide range of different measures related to housing, all of which point to some, if anything, a bit of acceleration here to start off 2024. So you put that all together, and what do we see? We basically see a circumstance where there's been 6 quarters of at or above potential GDP growth. That growth is broad-based. It's across many sectors of the economy: demand, manufacturing, housing, employment, investment, government spending. All of it is pretty strong. There aren't that many sectors of the economy at this point that are causing a meaningful drag on economic activity. And the early measures that we see for early 2024 is that growth will continue is continuing through the early part of the first quarter. Here we have the Atlanta Fed GDP Now estimate, which of course early in the quarter is subject to meaningful shifts. But that early data, which it gives indication on, suggests that we're running, just a touch weaker than where we were in the previous quarter, but still well above potential and well above analysts' expectations or blue chip consensus economists' expectations of GDP growth for the first quarter, which are still below 1.5%. And this continued strength in the economy has surprised, basically, not just at the sort of aggregate level on the left-hand side, but also at the individual stat level, where what you're seeing is an acceleration, an improvement in economic surprises that have really taken off here in the first part of January releases. And so when you look at this overall picture relative to what we talked about last month in the context or the framing of stronger for longer growth in the United States, this is basically playing out as you'd expect. If anything, the relatively significant market-based easing that occurred at the end of last year with a significant decline in interest rates, as well as the rise in stock markets, which was on a 2-month basis, the largest financial market easing that we had seen in the last 40 years. You would have expected that to start to translate into strengthening or continued strong economic conditions in the United States. And that's exactly what we've been seeing with the early data releases here in early 2024. So you've got a strong economy running above potential, and one that is strong enough to keep the labor markets tight. At the same time, we've seen continued reports of relatively subdued inflation. A lot of focus on the PCE numbers, which you see over there on the left-hand side, particularly the core PCE numbers, which have been very soft over the course of the last couple of months. Those numbers are certainly a key area that the Fed focuses on, and the consistency over the last 6 months with which those numbers have basically been roughly at the Fed's mandate at 2%, is certainly a good thing from the Fed's perspective. Of course, it's important to recognize that a large driver of that has been a significant weakness in goods prices, which are contracting in price relatively rapidly and on par with the big disinflationary environments of the earlier 2000s. And as Jerome Powell mentioned, it's not clear that we should necessarily rely on that goods disinflation to persist out into the future. And so there is some concern that we might have later in the year a rise in this inflation measure as a result of goods disinflation moderating when we have services inflation that continues to be relatively elevated. But overall, from a big picture perspective, from the Fed's view of things, we've got a pretty benign inflationary environment. And on the right-hand side, important to recognize there are some differences, and not to get too focused literally on the core PCE number, although it's there's a reason why the Fed says it's the preferred measure, not the only measure. And what you see with CPI is that it's come in just a bit stronger than what we've seen in the PCE side of things. And as the Fed mentioned in the press conference last week, it'll be particularly important to take a look at what's going on with the revisions, which come out tomorrow, to see whether they can increase their confidence that this disinflationary dynamic has occurred. And so where we are today with this strong growth, modest inflation, still some concerns about whether, modest inflation that is roughly at the Fed's mandate, with some concerns that it may not be able to stay there for an extended period of time. That's basically the suite of information we've gathered over the course of the last month, consistent with the stronger for longer narrative and thesis. Incrementally, not too much information other than a continuation of the trends that we've been seeing. The other concern that has continued to exist from the Fed's perspective is on the wage side of things, where wages, which of course translate into services pricing as well as nominal spending, continue to be a bit high relative to where the Fed would like them to believe that CPI was moving down durably to their inflation mandate. And so you see the ECI, which was sort of cheered as coming down in the most recent report, but is still elevated relative to where we were pre-COVID. Average hourly earnings, which came in a bit hot, partially due to technical reasons, but overall, forget the technical reasons and why it popped a little bit there in January. Just look at that chart over the course of the last, 2 years. I certainly wouldn't say that there's an obvious downtrend that's going on in average hourly earnings as you look at it there. And then, of course, we have the Atlanta Fed wage tracker, which the most recent print yesterday was a bit softer, although it came on the heels of a monthly print that was a bit stronger the month before. So I wouldn't probably read too much into it. Still running at about 5% on a reasonable moving average basis, year over year wage growth, which is still a couple of points elevated relative to where we were pre-COVID. And so that's really the underlying concern, is that even though we've had measured inflation reports over the last couple of months that have continued, that have been roughly at the Fed's mandate, and I emphasize at the Fed's mandate, not meaningfully below, not radically below. This is roughly at the Fed's mandate. These wage pressures continue to be a concern for the Fed about whether or not more structurally we're in an environment where inflation has meaningfully and durably dropped to the Fed's mandate. So if we look over the past month, we also received a fair amount of incremental information as far as policy. So the macroeconomic data circumstance basically looks the same as where we were to kick off the year. But we have had a fair amount of incremental policy news. And we talked about last month about how there was honestly a great deal of uncertainty about how exactly both the Treasury and the Fed would respond to the economic conditions as well as other pressures in the setting of their policy. And so that clarity that we've achieved over the course of the last 10 days or so has been critically important to understanding what the forward path of monetary policy will be, at least here for the first half of 2024. And so what we see here first is the Treasury issuance information that we received at the beginning of. And what we found, what has been the case for a while, you can see over here on the left-hand side, there's been a considerable amount of duration supply that was accelerating in the first quarter and has picked up over the course of the last year. And that gross supply here reported normalizing across different tenors for the overall interest rate risk is basically at highs of the last couple of years, and only was higher during periods of time where we had, the 2020 significant funding of issuance and build of the TGA. And so a lot of bond issuance is still coming. That's because there are large deficits, and because the Treasury, while choosing to issue a fair amount of bills on a long-term basis, is committed to continuing to issue meaningful amounts of duration. In this case, making a clear commentary that the step up in duration issuance is what they expect to be the case for an extended period of time. And so the result we see here is that duration issuance has picked up meaningfully, which is creating, will continue to be a significant supply factor in the bond market and overall asset markets. And so just to nail those numbers down, if we look here on the right-hand side, what you see in for the second quarter, this is all second quarter expected issuance, is that second quarter expected issuance is expected to be quite strong on a gross basis, 1,100 or 1.1 trillion in bond issuance. But probably even more important is on the net of duration issuance, the net of coupon issuance, which is expected to be about $520 billion over the course of a single quarter of coupon issuance. That's pretty much set. That won't change. It's possible this bills number may change if the deficit number, which looked a little low in terms of the projections, ends up coming in to be larger than expected. The Treasury will adjust with the bills side of things. But the coupon issuance is going to come, and coupon issuance of $500 billion or so over the course of the quarter is roughly double of what the coupon issuance is that we saw in the first quarter of this year, and is very high relative to history. And so that duration supply is going to keep hitting the market and keep hitting the market. Now you can see from the mix of duration supply that the Treasury is really focused on trying to keep it in the belly of the curve rather than out the curve, where it may be harder for them to get the demand that they're looking for. But still, this is going to require a fair, this is the type of flow, the type of issuance that is way beyond what anyone can front run. It's going to be day after day after day, these huge issuances. And unless there's a meaningful shift in economic conditions to shift the valuation profile of bonds, I think it's going to be hard to absorb all of these issuances. So I wouldn't read too much into that auction that occurred yesterday that went off pretty well. One auction, which is still not in the period where there's going to be elevated issuance, which is in the second quarter, not the first quarter. So I wouldn't, I'd be careful to extrapolate better financing conditions or okay financing conditions for the Treasury today to assume that will continue out for the first half of the year. So a lot of duration supply, and certainly if we look at or compare to a variety of different theories that the Treasury was going to act solely politically and issue a bunch of bills during this time, that obviously didn't happen. The technocrats to some extent won. The mix is nudged to bills, but at a big picture level, there are large deficits and there's large coupon issuance coming, and that will be a weight across all asset prices and particularly treasuries. On the Fed side of things, I think we also got an interesting picture where many folks, in fact, it was almost at 80%, were expecting a cut in March, and where Jerome Powell in the press conference, as well as subsequent to that in his 60 Minutes interview, really pushed back on the idea that there was going to be a quick shift to easing by the Fed over the course of the first half, at least, of 2024. If anything, probably the most interesting thing about that 60 Minutes segment was the voiceover from Scott Pelley, who said that cuts probably wouldn't come until the summer, which was quite different than what was priced in. And so you can see how the pricing over the course of the last month has really unwound the expectations of a cut. This is on the left-hand side of a cut in March. That's down to 16 or 17% this morning, down from roughly 80% to kick off the year, and where expectations of the Fed holding have increased. Further, you can see on the table on the right-hand side, we now have a near 40% chance that the Fed is going to hold not just in March, but also in May. And so that's starting to unwind, but it's being met with expectations of, some continued cuts through the back half of the year. And we still have, 100, somewhere roughly 5-ish cuts expected over the course of the year. That's come down from 7. Roughly 7 at its peak, but it's still at 5 cuts, given the mix of macroeconomic conditions that we're seeing, is still a question about whether that's going to occur. And so I think one of the more interesting things is we've got a lot of confirmatory evidence here over the course of the last month of the stronger for longer environment, confirmatory evidence that the Treasury will continue to bring significant duration supply into the market and increase that in quarter two, and that the Fed is unlikely to be nearly as easy as market participants had expected coming into the year. And yet, when you put the mix of things together, we really haven't had that big an adjustment in asset market pricing to reflect that reality, that confirmatory reality. And so certainly markets have moved, and they moved a fair amount from the start of the year. Over here on the left-hand side, I have stocks minus long duration bonds. That's moved, actually, that trade has moved almost 20% in the favor of stocks relative to long-term bonds. And it was a trade that it was highlighted right to kick off the year. In our 2024 outlook, as well as highlighted in our previous webinar to kick off the year. So that's moved a fair amount, but at a big picture level, we're still looking at stock prices relative to bond prices that are roughly where they were last fall. And so we've retraced the drawdown, which was looked inconsistent with the macroeconomic data that we're seeing, but we haven't gone meaningfully above where we were in October. And remember, since October, we've had, almost 100 basis points decline in bond yields and stock prices up 20%, all of which, and an economy that continues to roar along. You put that all together, and what do you see is you see a circumstance where there's probably more room to run on the stock versus bond trade that has done well this year. And then on the right-hand side, of course, we've got what cuts are priced into 2024, which we continue to see about 125 basis points of cuts priced into 2024, 5 cuts, which is certainly possible. But if you think about the macroeconomic reality of this level of strong growth and continued lingering concerns about inflation, what you'd have to expect, and plus the Fed that's made it somewhat clear that cuts aren't going to be coming till the summer unless something meaningfully changes. What you basically see in this mix of things is that you're basically pricing in a cut every meeting starting in the summer, and that's certainly possible. But given what we're seeing in the data, and given frankly what the various members are saying, it still seems overstated to expect 5 cuts in the market today. So these two trades, which I think are the two most obvious stronger for longer trades, have been in the money since the start of the year and look as though they have more room to run given what we're seeing. That's the basic story in the U.S. I think if look more broadly across the world, entering 2024, there was an expectation not just of cuts in the United States, significant cuts in the United States, but significant cuts globally across nearly all of the major developed central banks, the ECB, the BOE, the RBA, and the Bank of Canada, all expected to cut more than 100 basis points, almost 150 basis points coming into the year, something we highlighted a little while ago in our 24 outlook. And I think a big reason why that's expected is because these economies are expected to meaningfully decelerate as a function of the tight monetary policy that's been in place for a while. And I think, again, going to the data, looking at what we're seeing coming out of the reporting from those various economies, what it looks like is that the deceleration that is expected by many market participants, particularly bond market pricing, and is necessary to start to create a relatively swift shift to easing, has largely not materialized here in the opening part of the year. And so you see, we can start with Europe, which I think is a great example. What we see here is while growth overall is kind of mediocre, it's important to benchmark the European economy by what its potential is, which is its potential growth is essentially zero. The reason why that is labor force growth in Europe is roughly zero, maybe a touch over zero. And productivity growth in Europe is also close to zero. You put that together, even though we have had roughly zero growth in the European economy, which you see over here on the lower left-hand side, for really for 2 years. It's been basically at zero on an annualized basis. Unemployment rates have continued to decline and are at secular lows, which highlights the fact that the underlying capacity, the underlying potential growth rate of the economy continues to be so low that you can continue to tighten labor markets in an environment of zero growth. And that's really important because that situation where we have an environment of tight labor markets is continuing to create elevated wage pressures. And the ECB specifically mentioned elevated wage pressures as a concern, causing them to delay tightening or delay easing because that wage growth is so strong. And the measures of inflation, which have generally come down, core inflation have generally come down, have shown a bit of a spike back up, raising concerns from the ECB that maybe the inflation problem that had been experienced in previous, over the course of the last couple of years is not yet beat. So you look at that, and it's interesting, Lagarde is probably even more aggressive than Powell when speaking about the future path of monetary policy. But this idea of not even discussing what's going on, not even discussing an opportunity to cut rates, which honestly is consistent with the overall macroeconomic environment where inflation doesn't quite look beat and the economy is not weak enough to create an urgency to cut interest rates in the ECB. The UK and Bank of England is you're largely getting a similar picture. While growth has been relatively mediocre, employment conditions, with the most recent report this week, ticked back down below 4%. So secularly low unemployment. You have very strong wage growth, nominal wage growth that's well above inflation and in the 6-7% range, depending on how you look at it. Timely measures, which are the composite PMIs in the UK and also in Europe, are pretty good measures, unlike in the US context. You're actually seeing acceleration in the composite PMIs, including the most recent one over the course of the last week or so. So you're getting strength in the timeliest measures of growth, and you're seeing overall inflation rates, which have moderated to some extent, but are still not yet totally solved in terms of the inflation problem there. And so when you look at, a big thing when I sort of framed coming into the year, the basic risk that I saw, the risk in the markets or the mispriced dynamic in the markets that I saw was that it was very possible that we were likely to see economic conditions that didn't align with the significant cuts in interest rates that are currently priced in. And as we're getting this information coming in, both in the US context, which is growing quite strongly and has had a period of elevated inflation, but also what we see across the rest of the major developed economies. And I could show you, Australia and Canada here as well, that are basically experiencing the same combination of dynamics. Canada a little softer, Australia a little stronger. But overall, the real question is, why should these central banks move anywhere near as fast as what's currently priced into these short rate markets when they're facing the set of conditions that we're seeing here? And so the biggest risk continues to be that central banks disappoint in the magnitude of the easing across these economies than is currently priced in. Now, connecting that to asset prices, which I think is, we don't trade economies, we trade asset prices, is very important. And what I'd say in that context is, if we have an environment of strong growth or stronger than expected growth, which is leading to those cuts getting priced out, it doesn't necessarily mean that we're going to see a bad environment for equities. And if anything, what 2023 taught many people was that an environment where the economy is strong and cuts start to get priced out is a good environment for stocks as growth continues to outpace expectations, and a particularly bad environment for bonds. And so when I look at this overall mix of things, I don't think there's much here that creates a lot of concern for the equity market until we get bond yields rising to the extent that they start to meaningfully constrain economic activity, and we're not there yet. So not a lot dragging down stocks, with expectations and concerns that, certainly from parts of the market, that we were going to have a really weak economic environment. And so bad for, fine for stocks, but particularly bad for bonds, particularly in the US context, on the short end, as the pricing that's currently priced in is unlikely to be achieved, but also on the long end as that duration supply comes in. And so we could easily see a mix of dynamics where we have stocks continue to move higher, as we've talked about over the course of the last couple of months, at a time when we get the short rate market, the twos selling off, and the longer end of the market selling off even more, as they're hit both by the duration supply as well as the pricing out of the expected cuts. So you put that together, good for stocks, not great for bonds. For commodities, in general, that's a good environment, should be incrementally good for commodities, particularly extractive commodities. But a lot of that hinges on China, which we'll talk about here in a minute. So I think, China, in many ways, we've been through a lot. There's a lot of focus on Chinese equity markets, and the fact that Chinese equity markets continue to go down, particularly relative to developed economies, and drawing parallels to what happened in 2018 or 2015 and 16, when we saw stress in China flow through to developed markets. We're not seeing that kind of stress flow through to developed markets today. And the primary reason why that is that the Chinese stock market is not the Chinese economy. And if anything, those two things are meaningfully diverging from each other. And what we see here on the left-hand side is, of course, the difference in the stock prices of the Chinese stocks, which have continued to plummet new lows, despite, I'd emphasize, many different government attempts to stabilize Chinese stocks, none of which have gone to fruition. The reason why that is that the various interventions in that market haven't done really anything to change the underlying fundamental dynamics, economics of those stocks. They've just tried to intervene or create short-term pops of confidence in that asset market. So they've continued to decline. But interestingly, when you look across the actual real economy information that can be drawn from timely commodity price outcomes, as well as trade information, which is probably the highest quality data, the sort of realist data that we can see, because we can see it also on the importer side of where it's coming from, what you see is actually things are totally fine. In the middle column, what you see is iron ore prices there at the top, steel prices, as well as copper prices. What's going on with all of those? The answer is not much. If anything, prices across those commodities are up relative to where they were last summer, and during this period of significant equity market decline, have largely been stable to up during that period. This is not, if China's economic conditions were meaningfully deteriorating, what you'd see here across this middle column is you'd see a lot of weakness in these assets, and you're not seeing it. And that's also confirmed by what you see on the right-hand side, which I think is important to look at the actual exports. Now, of course, China's a big diversified economy with a lot of domestic demand, but the export sector gives you a lot of insight into what exactly, it gives you a timely insight into whether there are big shifts going on when looking at imports, whether there are big shifts going on with domestic demand, and whether from exports, the manufacturing sector is significantly deteriorating. And again, in the context of the normal volatility of Chinese exports and imports, what we're seeing is something that, had a big boom right after COVID. For instance, the exports had a big boom right after COVID, given the restocking that moderated, and now it's been mostly stable. And on the import side, similar dynamics, largely stable over the course of the last year or so when it comes to the import picture. And so what that adds up to is that if you want to understand China's impact on the global economy, stop looking at their equity market. And the reason why that is that, the equity market is primarily domestically oriented, primarily driven by domestic supply and demand considerations, and is primarily not a reflection of the economic conditions of China. There's all sorts of different policy things going on. The nuances of Chinese political considerations is above my pay grade, other than to say it's very likely what we're seeing is a set of policies that are being pursued that are inconsistent with the style of policies that exist, that you'd expect from Western style economic management. And so it's important to remain open-minded that is a reality, is that they may be pursuing, they may not, for instance, desire to have a buoyant equity market for all sorts of domestic consideration reasons, and instead be more concerned with having a stable but not extreme set of economic growth in the domestic economy. And that's essentially what it looks like they've achieved, and honestly what it looks like they've achieved over the course of the last couple of years, which is stable, fine, kind of mediocre economic expansion, which is neither being meaningfully accelerated by big injection of credit and fiscal stimulus, nor is really being allowed to weaken all that much more, given the steps that are being taken that are responsive to areas of weakness. And so China, in many ways, right now looks like flat, not the primary driver of the incremental changes in the global economy, just kind of a steady, modest demand given their policy choices. So with that, we will let me take some questions. If you all have questions that have been following along, definitely chuck them into the Q&A. I'll try and get to as many of these as possible. Let me start with the first here. I had I'm going to go through a few of the submissions earlier. The first is basically, what are your thoughts on the emerging credit issues coming into the CRE sector? Obviously, gotten a lot of attention with New York Community Bank over the course of the last week. New York Community Bank is concerns or issues is a highly idiosyncratic situation, one that I wouldn't draw a lot of parallels to. I think a lot of folks are just assuming are drawing a connection between the current CRE problems, and particularly office CRE problems, and the types of conditions that we saw during the global financial crisis. And I would emphasize that there is a radical difference between those two environments. And the reason why that is first, CRE is on-balance sheet lending. On-balance sheet lending takes time to be recognized. Those losses, those delinquencies and losses take time to be recognized. Those losses only get recognized once there's non-payment and can be extended, modified, adjusted. There's lots of different things banks can do to push out the losses over time. Number two is the nature, the economic exposure that the banks have and the risk that they have is because it's in loans, doesn't have to be marked to market nearly as quickly as what we saw in the global financial crisis. The global financial crisis, those were securities holdings. Those securities holdings had to be marked to market relatively close to fair value relatively quickly. And so you have a situation with CRE that's likely to play out over 10 years, let's say. And even if you had double financial crisis losses in CRE relative to the acute crisis that happened with residential real estate securities, that would be a totally different dynamic for the banks today, because it would give them years of earning power. And in fact, what you did is you went through and you assumed that the CRE losses, the total CRE losses for these banks were double what they were in the Depression, which would be an extraordinarily loss rate, and you gave them 5 years to recognize them, they would earn, for the small banks, they would earn more NIM, more incremental NIM, even if their NIM was cut by 50%, then would be the total loss rate across all of those loans that they have on their books. So what it means is you could have extraordinary losses as long as the banks can push off the losses into history, earn NIM, even depress NIM. They can absorb it without even going into their already relatively elevated regulatory capital. And so the thought, I think a lot of people are looking around and saying, let me find the next crisis and the next crisis. It will not come from CRE. And take that from a person who called the financial crisis right and also called the SVB circumstance not derailing the economy right. They're two totally different circumstances, two totally different times. Got a question here about what could derail the Mag 7 besides higher rates. I think one of the things that's really interesting about the Mag 7 is how much of the earnings that you're seeing from the Mag 7 is not novel. It's not coming from novel AI or technology. Like, what is Meta or Google? They're technology companies, but really what they are point of the spear advertising companies. And so in a lot of ways, what we see, or what is Amazon? Amazon is an advertising company, a consumer demand company, and a business investment company. Right. And so what we're seeing with those companies, if you actually get into their transcripts, get away from the hype and the the future, the future that's being painted by various people. If you get into the nuts and bolts of the earnings, what you see that these companies are doing well because consumer demand remains elevated, and companies are responding to that consumer demand by advertising and by investing. And so as long as that dynamic continues, in a lot of ways, what we're seeing with the Mag 7 is not necessarily novel technology, but a set of companies that have the highest betas to economic conditions. And so it's not surprising that when there was concern about economic conditions and actual softening in late 2022, that those companies underperformed. And it's also not that surprising that in an environment where economic conditions continue to be very strong, and are stronger than people expect, for those companies to actually create, to continue to strengthen. And so I think in a lot of ways, focusing on the Mag 7 are a better representation of the most cyclical parts of the U.S. economy, much more so than they are representations of novel technology. Let's go. Let's go to another question about someone mentioned here basically that the economy is doing fine, yet you're not actually seeing a lot of strength, particularly in oil. Any market comes down to supply and demand. And one of the key things, that's not really being talked about a lot, sort of in the general consensus, is just how much oil supply has come into the market, particularly from the U.S. U.S. production is pushing new highs. And a lot of what we're seeing in order to prop up the price is that OPEC has to cut in response to the significant U.S. oil supply that's coming on. And so while oil prices have been relatively contained in the context of an overall strong economy, an important reason why that is because of that supply factor. And so there's good reason to believe that will continue to be pretty strong, pretty healthy domestic oil supply, which is going to, which will possibly keep a lid on the strength of the market relative to other areas, and also I think in that context helps create, keep inflation pressures down, which should advantage stocks during this environment. Let's get some of these questions that came in while we were talking. We'll try and hit a couple of these. Let's see. Just running through these. I think I think a good question here, which is always important as we're looking at these data coming in, which is, what would make you change your mind on the global economy before other people see it. And this also connects to, do you expect for conditions to eventually lead to recession? And what I'd emphasize with that is that there's an order. For those of you who have been around these conversations for a little while, you've heard me talk about the order. And what the order is there's a set of linkages that need to occur in order for us to get to a point of where the economy is going to meaningfully slow into a recessionary environment. The basic idea of stocks are likely to continue to outperform bonds as long as the economy is strong. The economy is likely to be strong as long as stocks and housing prices remain elevated, and stocks and housing prices are likely to remain elevated as long as bond yields don't rise too much. And so that set of linkages, it's a very important set of linkages, because what it sits on is whether or not there's a sufficient market-based tightening in the bond market to start to create both a hit to asset prices and a hit to economic activity. And if anything, what we've seen over the course of the last 6 months is that bond yields have come down, not up. That is incrementally stimulative, not incrementally tightening. And so in order, again, to go to those linkages, in order to get the eventual recession, you have to get that bond yield to rise, which then hits asset markets, which then hits demand, which then hits earnings, which then hits employment, which then hits incomes, which eventually creates the negative reinforcing cycle. And so if we go to this question, what would change my mind about the global economy would be going through that environment of enough of a rise in bond yields to start to create those significant drags on asset prices in the economy. And I think actually that the period that the sort of fall period last year was really instructive because we had bond yields press all the way to 5, and we had a modest sell-off in stocks. But go look at the underlying economic data. We didn't really see, if anything, the third quarter was particularly strong, a little bit, goofy technical stuff, but the fourth quarter was very strong. And so I think that gives you a sense that highlights the type of underlying strength that exists in the economy and really how far, you'd have to have those rates move up for an extended period of time and have stocks move down for an extended period of time to get there. So by focusing on the linkages, that's how you're going to get edge ahead of markets and the economy in predicting what's likely to transpire. And in that context, I'll answer this other question about a target for tens. Now, in general, I don't think that trading to a target makes a lot of sense, and the reason why that is there's a lot of unknowables and they can change. But what you can start to do is think about what are the pressures and where does value come in? What's a fair value of where we are with a variety of securities? And that, I think that's helpful in sort of benchmarking where we are in that process. So, today on tens, we're at 415, give or take. And when I think about tens, what I think about sort of a more structural fair value, what I'd say is that, something like, let's say 2% real rates, given the strength of the economy, inflation expectations of maybe 2.25, let's say 2.25. And then I think a term premium that has yet to be fully reflected. We have a term premium after this rally that's back to negative rates. And so a term premium that looks something like 75 or 100 basis points, give or take, is a more normal term premium, the type of term premiums that existed prior to the financial crisis, and would take bond yields at fair value to say roughly 5. And so, does that mean that we're absolutely on the fast track to 5 and, we're going to go through it? Not necessarily, but what it means is that, when I look at 415, I say we at least got, 30, 40, 50 basis points of move up here before we start to get into a fair value range. Let me, I think there's a couple questions here, and I'll before I wrap up. So I think there's a couple questions about the fiscal situation going on as well, which, look, fiscal deficits are relatively substantial. There's a lot of questions about whether there is an ability to fund the elevated fiscal deficits, particularly with the magnitude of the issuance that's coming to the market, and whether that'll start to create policy implementation that could constrain further bond yield rises. The first thing I'd say is fiscal policy is relatively loose. There's the reasons. We sort of all know the reasons why fiscal policy in the U.S. has been so expansionary. The two different parties and candidates for president are largely appear to be in favor of expanding the fiscal deficit or continuing elevated fiscal deficits during good economic conditions. They have slightly different flavors of it between tax cuts and business subsidies versus transfer payments to lower income cohorts. But the basic story is we're going to be here with large fiscal deficits for an extended period of time. The question of whether they can get financed is an important one, but one that really is more a question of at what price in the medium term. We could easily have this amount of issuance, have a much more normalized term structure, term premium for buyers of bonds. That more normalized term premium can happen through a variety of different ways. It could happen through lower short end rates. It could happen through higher long end rates. We're not, radically far away from being able to shift prices and yields to be able to create something that is significantly more attractive relative to cash. And so in the sort of shortish term, let's say the next year or two, I don't really see a meaningful concern. The real concern would come if the deficits are so large that it causes interest rates to rise at a time when that sort of rise is inconsistent with desirable or reasonable monetary policy. Right today, we have upward pressure on yields, in part because there's, the economy is pretty good. And if anything, we probably use a little tightening on the long end. And so the question of yield curve control and how the Fed will respond really is a question of how things will transpire when we get an environment where we a significant economic downturn, are in need of easing, and therefore need to ensure that the long end doesn't rise too substantially. So that is like well ahead, not something that if you're trading markets today really makes a ton of sense to worry about or consider. And I'd also emphasize that I think we keep getting these small tests in terms of whether people are interested in buying US duration. And look, like bond yields just went down 125 basis points. I think the idea that there's, on a modest concern that there would be weakening economic conditions, I think the idea that people are going to totally go away from the US bond market, particularly in an economic downturn, my guess is that won't happen, or it'll be a modest effect rather than a significant effect. But the central bank and the Fed has the tools necessary to be able to respond to those conditions.